This is Ken Griffin. He is the hedge fund manager of Citadel, and in the year 2022, he made $4.2 billion for himself. This is the most money ever made in the history of a hedge fund manager. Hedge funds are extremely profitable, and one of their advantages is that they generate high returns regardless of market conditions. However, these hedge funds also have significant risks, including the possibility of losses and higher fees. So in this video, we will see what exactly a hedge fund is and how they make so much money. A hedge fund is a limited partnership of private individuals or investors, such as pension funds, insurance companies, etc. The money is managed by a fund manager. Hedge funds require a high minimum investment, which is why they are usually offered to only wealthy people. On top of that, many of these hedge funds have a lock-in period of about 1 to 3 years. Hedge funds have different fee structures. Usually it is 2 to 20 basis points, where 2% is the management fee and 20% is the performance fee. So if the $1 million investment rises to $1.2 million, then $40,000 is the performance fee an investor has to pay to the fund. The hedge funds use multiple strategies to get the most returns. We will see details of some of the methods here. The first method they use is the long-short equity method. In simple terms, it means buying some things and selling some other things to make a profit. Imagine you have two toys, a red car and a blue car. You think the red car is worth more than the blue car, so you decide to sell the blue car and use that money to buy more red cars. Now you have more red cars than blue cars, and if the price of red cars goes up, you can sell them for more than what you paid for them and make a profit. This is what hedge funds do with stocks. They buy some stocks they think are undervalued and sell some stocks they think are overvalued, and if they are right, they can make a profit. The second method they use is the global macro. This means hedge fund managers are trying to make money by making big bets on things that are happening around the world. It's kind of like playing a big game of guess what's going to happen next. For example, let's say the people managing the hedge fund think that the price of gold is going to go up. They might buy a lot of gold with the money in the hedge fund. Then, if the price of gold does go up, they can sell it for more money than they bought it for and make a profit. Or maybe they think that a certain country's economy is going to do really well. They might invest in that country's companies or buy its currency. Then, if the economy does well like they thought it would, they can make money on those investments. Hedge fund managers have to be updated with what's happening in the world. Based on that, they make their bets and make most of the returns. Many times, these bets do not go as planned, and these hedge funds lose money. The third method is event-driven. Have you ever heard of a corporate event? This is when something big happens to a company, like when they merge with another company or go bankrupt. Sometimes, when these events happen, the stock price of the company can go up or down a lot. Now imagine that you have a lot of money and want to make more money by investing it in the stock market. A hedge fund manager who uses the event-driven strategy might look for companies that are going through one of these big events and then decide whether to buy or sell their stock. For example, let's say that a company called Company A is going to merge with Company B. The hedge fund manager might think that Company A's stock is going to go up because of the merger, so they might buy a lot of Company A's stock. At the same time, they might think that Company B's stock is going to go down because they are being acquired, so they might sell some of that stock. In short, the event-driven strategy is all about finding big events that are happening to companies and then making smart investment decisions based on what the hedge fund manager thinks will happen to the stock prices of those companies. The fourth method is distressed debt. When a company borrows money from others, it is called debt. Sometimes a company might not be able to pay back the money it owes, and this is called being in financial distress. When a company is in financial distress, it might need help reorganizing its debt so it can pay back what it owes. This is where a hedge fund can come in. A hedge fund that uses the distressed debt strategy will buy the debt of a company that is in financial distress. This means that the hedge fund becomes one of the people or organizations that the company owes money to. Once the hedge fund owns the company's debt, It can work with the company to restructure the debt. This means that the hedge fund and the company will come up with a new plan for how the company will pay back the money it owes. If the company is successful in restructuring its debt and paying back what it owes, the hedge fund can make a profit from the investment. If the company is not successful and can't pay back what it owes, the hedge fund may lose money on the investment. The fifth method is arbitrage. So let's say you have two stores next to each other that sell the same toy. One store sells the toy for $5 and the other sells it for $10. If you bought the toy from the first store for $5 and then sold it to the second store for $10, you would make a profit of $5. Now imagine that instead of two stores, there are two stock markets. And instead of a toy, there are stocks that are traded on both markets. Let's say that the stock is trading for $50 on one market and $55 on the other. A hedge fund manager could buy the stock on the market where it's trading for $50 and sell it on the market where it's trading for $55, making a profit of $5 per share. This is called an arbitrage trade. These are some of the methods hedge funds use to make money. The people who run hedge funds are really smart and have taken every probability into account before making investments. The more profitable the hedge fund is, the more money hedge fund managers make. So there is an incentive for everyone who manages these big hedge funds. The biggest hedge fund in the world is Bridgewater Associates, which has $126 billion in assets under management. The manager of this hedge fund will easily make a minimum of $2.5 billion just from managing the fund. And if the fund makes a profit, then with the performance fee, the fund manager will make even more money. We hope you understood how exactly hedge funds work and how and why they make so much money. If you found this video helpful, then give it a like and subscribe to the channel to learn more about money.